All right, in this video, we're going to introduce the 4 financial statements. So essentially, the entire purpose of accounting is to arrive at these 4 financial statements so users can make decisions based off of these 4 statements. So let's just say hypothetically that we go to the bank with our financial statements because we want to get a loan out. The bank's going to look at our financial statements to determine how healthy our business is, like how many assets we have in comparison to our liabilities and shareholders' equity. Now, they're also going to determine if we have enough money coming in or if we're generating enough income to pay off our interest obligations as they come due. That's going to be inputted on the income statement. Or let's just say hypothetically, investors want to invest into our business now. So they want to see what our financial health is, what our profitability level is, etc., etc. So these are all determined based off the financial statements. So the first financial statement is that of the income statement, which in other words is a statement of financial performance. So we can have multiple types of income statements. We can have the single step income statement, we can have the multi-step income statement, we can have the consolidated income statement, or we get a statement of income. Essentially, the multi-step income statement, consolidated, and the statement of income are just different words for the multi-step income statement, whereas a single step income statement just kind of pulls together all the revenues and the expenses, and then we get net income, whereas the multi-step income statement breaks it down to derive further information. Then we have the statement of changes in equity. So depending on the company or the course that you're taking, either it could be the statement of changes in equity or it could be the statement of retained earnings. However, the statement of changes in equity, remember, in shareholders' equity, we have 3 main accounts. We have common shares, preferred shares, and we have retained earnings. The statement of changes in equity just kind of deals with what happens in those 3 accounts throughout the year. So the statement of retained earnings is actually inputted into the statement of changes in equity already. And this could be a consolidated statement as well. Then we have the balance sheet. Another word for the balance sheet is a statement of financial position, or it could be the classified balance sheet or the consolidated balance sheet. Then we have the statement of cash flows. The statement of cash flows deals with cash coming into the business and cash going out of the business. So that's divided to 3 different activities: investing, financing, and operating.